CME margin hikes sent gold prices into free fall late yesterday afternoon and into today. Someone who was not surprised by the news is Gero of RBC Wealth Management. He joins me on the line. George, when we spoke a few weeks back, you had anticipated that the CME might pull this move again, so no surprise there for you?
And I'm not surprised at the selling now either, because I do believe that margin selling ensues usually after any big downdrafts. And with tomorrow, fearsome Friday, because of the Bernanke speech, and then today's jobs figures, people are taking a back seat to see where the markets will be after next week's option expiration. The reason option expiration is important next week is the option open interest has been much bigger than the futures option interest. Part of it has to do with the high margins. I mean, let's face it, to take 10 lots, you have to put up close to $100,000 in margin money. So the options are a cheaper alternative to a lot of traders. Now, after option expiration, we'll see how the December to February rollover starts, although it's a little bit early. But a widening of that spread from 160 would signal some buying where people are already moving past this year into next year, a bunch of gold positions.
George, is there any way to foresee or anticipate when the CME plans to do these hikes?
No. These hikes are based on span margining, which isn't so much the price of the commodity over any period of time, but the volatility. And the volatility is measured by the clearinghouse staff, and they come up with the recommendations for margin increases or decreases.
George, do you think we'll see a lot of movement in the gold market following tomorrow's Fed meeting?
Yes, I do. I think that Bernanke's speech tomorrow is going to be key to lots of markets.
All right, George, thank you so much for this quick update. Stay tuned to Kitco News for all your breaking information in the precious metals sector. You can email me your comments and questions at newsfeedback@kitco.com.